Let me ask you something honest. When was the last time you actually looked at your portfolio? Not just glanced at the number, but really looked at what's inside it, why it's there, and whether it still makes sense. If you're like most people, the answer is probably a while ago. Maybe you set it up years back. Maybe you followed some advice you heard. Maybe you just put money into whatever your company's 401k defaulted to. And then life happened. And here's the thing. That's not a character flaw. That's just how most people manage their money, passively, on autopilot. But here's what keeps me up at night. The environment your portfolio was built for, it may not be the environment we're heading into, and the gap between those two realities could cost you years of progress. Look, the set it and forget it approach to investing made a lot of sense for a long time. From roughly 2010 to 2021, interest rates were near zero, inflation was tame, and you could throw money at almost anything and watch it grow. A basic 60-40 stock-bond portfolio, the gold standard of balanced investing, returned an average of about 10% per year in that decade. You didn't need to be smart, you just needed to be invested. But here's what most people don't realize. That era was historically unusual. Abnormally low interest rates for over a decade created what economists call a everything bubble, where nearly every asset class, stocks, bonds, real estate, crypto, inflated simultaneously. And in 2022, when rates finally started rising, the 60-40 portfolio had its worst year since 1937, lost nearly 16% in a single year. Not because people made bad decisions, but because the rules of the game quietly changed while everyone was on autopilot. So what's the environment we're moving into? Let me be direct, because this is important. We're entering a period of what economists call structural volatility. That means we're not just dealing with a temporary blip, we're looking at a confluence of forces that will likely keep markets unsettled for years, not months. First, interest rates. After years near zero, rates are settling at levels we haven't seen since the early 2000s. That changes the math on everything, from bond yields to real estate valuations to how much companies can borrow to grow. Second, geopolitical fragmentation. Supply chains are rewiring. Trade relationships that existed for 30 years are being restructured. That creates inflation pockets that are harder to predict and harder to hedge. Third, the AI productivity shock. This one cuts both ways. AI is creating enormous value, but it's also disrupting entire industries and labor markets faster than policy can respond. Some sectors will boom, others will structurally decline. Here's the uncomfortable truth. A portfolio built for the 2010s is like a car tuned for highway cruising being asked to navigate mountain roads. The engine might be fine, but the setup is wrong for what's ahead. Now, here's where it gets specific. Most unprepared portfolios share 4 common blind spots, and I want to walk you through each one. Blind spot number 1, too much concentration in U.S. large-cap growth. The top 10 stocks in the S&P 500 now make up over 35% of the entire index. That means if you're in a basic index fund, which most people are, you're not as diversified as you think. You're heavily exposed to a handful of tech giants. And while those companies have been extraordinary, concentration risk is real. In 2022, the Nasdaq fell 33%. Anyone who thought they were diversified in an index fund got a painful lesson. Blind spot number 2, duration risk in bonds. Most people hold bonds for stability, but here's what almost nobody explains. Long-duration bonds behave like stock growth stocks when interest rates change. When rates rose in 2022, the iShares 20-year Treasury ETF, one of the most common bond holdings, fell over 31%. That's not safe. That's a stock-level loss from a bond. Blind spot number 3, no real inflation protection. Most standard portfolios have almost zero explicit inflation hedges, no tips, no commodities, no real assets. In a world where inflation could remain structurally elevated, not at 8%, but persistently at 3 to 4%, that gap quietly destroys purchasing power over a decade. 3% inflation over 10 years erodes 26% of your money's purchasing power. On a $200,000 portfolio, that's $52,000 quietly gone. Blind spot number 4, overexposure to the narrative of the last cycle. This one is the psychological one. After 2010 to 2021, most investors are unconsciously wired to buy the dip in tech, trust that bonds provide safety, and expect inflation to be transitory. Those instincts were correct for that era, but instincts built from one long cycle can be the most dangerous guide into a new one. So what does preparation actually look like? Not paranoia, preparation. Here's the framework I'd suggest thinking about. First, geographic diversification. International developed markets, Europe, Japan, parts of Asia, are trading at significant valuation discounts to the US right now. The MSCI EAFE index trades at roughly 14 times earnings versus over 20 for the S&P 500. That discount is a cushion. It doesn't mean abandoning the US, it means not being 100% in it. Second, duration management in fixed income. Shorter duration bonds, think 1 to 3 year treasuries, give you yield without the rate sensitivity. In a volatile rate environment, shortening duration is one of the simplest, most effective adjustments most people never make. Third, adding real return assets. A 5 to 10% allocation to inflation-protected securities, commodities, or real asset funds gives your portfolio a layer that explicitly benefits when inflation persists. This isn't complicated, it's just intentional. Fourth, building in some cash optionality. In a volatile environment, cash isn't just a drag, it's ammunition. Having 5 to 10% in short-term, high-yield instruments means that when opportunities emerge from dislocations, and they will, you have the ability to act. Most people are fully deployed and have nothing to fire when the best buying opportunities appear. Here's something concrete you can do this week. Run a simple stress test on your portfolio. Ask yourself 3 questions. 1. If the S&P 500 fell 40% tomorrow, roughly what happened in 2008, what percentage of my portfolio would be directly impacted? If the answer is more than 60%, you have concentration risk you may not have fully priced in. 2. If inflation stays at 3.5% for the next decade, what assets in my portfolio explicitly benefit from that? If the answer is none, you have an inflation gap. And 3. If I needed to rebalance towards better opportunities 6 months from now, do I have any liquidity, cash or short-term instruments to do so without selling at a loss? If not, you have an optionality gap. These aren't trick questions. They're the questions every wealth manager asks when reviewing a client portfolio. The fact that most people have never asked them of their own portfolios is exactly why most portfolios aren't ready. Here's what I want to leave you with. Being unprepared doesn't mean you're going to lose everything. Markets are resilient. Good companies survive cycles. Long-term investors almost always win if they stay the course. But staying the course only works if the course you're on is actually pointed in the right direction. The people who build real wealth through volatile periods aren't the ones who predicted the future correctly. They're the ones who built portfolios that could handle multiple futures without requiring them to be right about which one arrived. You don't need to overhaul everything. You need to ask honest questions, make a few deliberate adjustments, and stop running on autopilot in a world that's shifted underneath you. The window to prepare is always now, not after the next correction, not after you see how things develop. Now, while you still have choices. Take 30 minutes this week. Look at what you own. Ask the 3 questions, and if you don't like the answers, start fixing them. If this helped you think more clearly about where you stand, subscribe, and I'll see you in the next one.